The Financial Huddle does not provide tax, legal, financial, or other professional advice. Listeners are encouraged to consult with their own advisors in these areas.
All right, everybody, huddle up. Play calls in. This is the Financial Huddle. Ready?
Well, hello, everybody. Welcome, huddlers. Welcome to the Financial Huddle. I am Brian Menier, here with my compadres, Ryan Fleming and Ed B. Miller. Gentlemen, how are we today?
The Huddle Nation, here we go.
Welcome.
Yeah.
Let's get
Welcome back, everybody.
That's right. Let's get after it. So we are going to be talking about part 2 today of the One Big Beautiful Bill. Sometimes I like to call it the OB3. Just
Part duh.
That's right. And so what we want to talk about today is specifically the tax brackets, and I like to say this in air quotes, that were made permanent. They had an expiration, and now they are not going to expire.
Permanent until they change.
Permanent until they change. That's right.
As with most things related to the government and policies.
That's right. Now, I got to say, thinking of things that have not changed, we are all, unfortunately, Cleveland Browns fans.
Oh, no.
I know.
I know where you're going with this.
Where we're going.
Born and bred.
Born and bred. And as we think about our beloved Brownies, we thought, you know what, losing was going to expire at some point in our adult lives.
This was the year it was supposed to.
This was the year. Great defense, good draft pick with our running back, and we know now, being the thick of in the season, we're still losing.
Well, they did get rid of Joe Flacco a few weeks ago, so at least they put in some fresh
Thinking
meat.
of things that don't expire.
Things that don't expire, at least, living in Ohio, and I've listened to a lot of, which I know we all do, sports talk and everything else, and I've heard comments saying, thank God we have the Ohio State Buckeye football team. Because on either side, of the state of Ohio, the pro football season has not been one of great success.
No, Saturdays are good. Sundays we usually go to bed in a bad mood. So
either that, or I just, it gives me time to do a lot more. Whether it's yard work or go on a long bike ride, or it gets to a point where I've gotten older, it's just like, all right, why am I doing this?
Yeah.
Why am I putting myself through this?
The question is do you think the Browns will win a Super Bowl before we die?
I'm going to say yes.
Really?
I expect to live a long life.
Wow.
Yeah.
I'm not holding hope personally.
It's kind of like buying a stock, man.
Yeah.
You never know.
Well, speaking of things that will help us and will put us in a good mood, as we talk about the One Big Beautiful Bill, and there's a lot of different aspects to it. We talked about 3 things during our last episode, but this one in particular, we want to talk about what the brackets look like, and now that those were made permanent. And so in order to understand that, we got to talk a little bit about the history of how we got here. So many folks probably remember back in 2016, President Trump signed the Tax Cuts and Jobs Act. And what that did, there were multiple things that particular act did, but a couple things specifically that were a big deal to a lot of people, where it increased the standard deduction, and then it also changed the tax brackets, and it benefited everybody from top to bottom. A lot of people would kind of argue with that and say it was more towards wealthier people, but if you look at the brackets and you compare what they were to what they are now, it provided tax cuts across all the different levels of income. And so what we know, we used to talk about this when we go to classes and talk to our clients, is that was set to expire in 2025. And so we used to tell people, hey, if you're going to make changes, make sure that you do this. You have just a limited amount of time to make those changes, because it's going to revert back to what it was in 2016. Yeah. We had
that created a lot of anxiety with the last election.
It did.
And I know a number of my clients, and some in particular went as far as to saying, well, I need to see who wins the election before I make any financial decisions because of the impact of taxation.
Don't matter.
Similar conversations.
Right. Don't matter. Yeah. They're all inheriting a math problem, right? So it really doesn't matter in that respect.
So come July 4th specifically, this act, the One Big Beautiful Bill, was now came into existence. And now the brackets that were changed back in 2016 that were set to expire in that 10-year period are now permanent.
Yeah. This is
Until they're not.
until they're not, right? This was probably one of the biggest surprises of the bill. A lot of people in our industry had thought that the sunset was going to happen. It was almost kind of like a given. But the fact that they didn't really just, for our people out there, our audience that are listening or watching, all the way back in 2008, before the Tax and Job Acts happened, there was a guy named David Walker, and he was the U.S. former Comptroller General of the United States of America. Basically, he was the CPA for America, and he worked underneath the Bush and Clinton administration, and he was so concerned about, the taxes being low, and the spending being so high that there was going to be a day of reckoning. And so he actually resigned from office back in 2008 under this premise that, we were heading into some dark times if we didn't do anything. And so what he did, he started scouring the country trying to raise the warning cry that, if we don't double taxes, he's on record and saying that we would have to double taxes to kind of shore up our fiscal state here in America. And not a lot of people would listen back then. He went on NPR, and people were chiming in, trying to figure out why he says taxes have to double. But really, what David Walker knew is he knew the math, and that's why I said that earlier. It doesn't matter if you're a Democrat or Republican. This is an apolitical podcast, but both sides have kicked the can down the road, if you will, the proverbial can down the road with the taxes being so historically low and the spending being so high. And there's going to be a day of reckoning. And David Walker was right. He went into Congress and said, this, you guys don't understand. You got about 78 million baby boomers that are exiting the workforce. They're going to start to turn on these entitlement programs like Social Security, Medicare, Medicaid. They're going to start selling their assets. And you don't have to double taxes now, but every year that you don't raise taxes or double taxes, it's going to be a more draconian end, a more stiff penalty at the end. And now here we are in 2025 with the extension of these brackets. And I just got to tell you, this is a tax sale of a lifetime for many people. If they understand the rules, the regulations, they understand and are educated, they can make better decisions.
And I know one thing, and I know we all use it, when you look at that tax chart of the tax brackets for the last, not decade, but last century, we're in the lowest quartile. And everyone likes to complain about taxes,
yes.
But, you just mentioned, we're in one of the most favorable tax brackets.
And I'm glad you brought that up, because another thing I learned about David Walker is that he knew the math. And so what he did is he went to the Congressional Budget Office and he says, okay, you bean counters in here, I want you to crunch all the math. I know the shortfall on Social Security, Medicare, Medicaid. Medicaid costs 5 times more than Social Security does. He said, crunch the math. And he goes, based on today's brackets, what would brackets have to be projected to rise to plug the hole, I guess. And what the Congressional Budget Office came back and said was the 12% bracket today is going to have to rise to 25%. The 24% bracket today is going to have to rise to 63%, and the 35, 37, the top bracket that we are today, is going to have to rise to 88%.
That's just crazy.
Which is crazy, but
how do you think that would be received by the general populace?
But the question was there ever any historical precedent that was so? And if you go back and look at 1960 to 1963, that was almost the exact to the percentage brackets that we had at that time. So there's historical precedent. Taxes are on sale of a lifetime, near or at low values of all time federal income tax brackets. And if we don't do something to get off the tracks, then the tax train's coming.
Yeah, and as a planner, it's actually really exciting because you can provide assistance and help to those of us that we work with, because this is a great opportunity to do tax planning to mitigate those taxes in the future. As taxpayers, we love to hear taxes are going down. We were probably all very excited to hear, hey, these brackets are going to be made permanent, because it allowed us to keep them lower compared to what they were even a decade ago. And if you apply the standard deduction, that was set to be cut in half, and now we get to keep it where it is. So it's great, but as Ryan said, there is a day of reckoning. And I know we got to do stats every episode. And I think, Ed, you got some stats for us that are specific to some of the major services that our federal government provides for us.
Yeah,
what are some of those stats?
Stat time.
It's that time. It's that time of the podcast. So, we look at what is really being, talked about a lot of discussions that are taking place, around Medicare, around Social Security, around the federal deficit. What are we going to do? And we all speak to people, whether on the left or the right, and some get a little bit carried away with, they don't think anything's going to be around. There's going to be no money left for anything, and we're going to move to a barter system. And if, you don't have cows and gasoline.
Lord of
and
the Flies.
Yeah.
Seeds.
I always use the Walking Dead analogy.
Yeah,
it's just like, all right. But, it is something. It's a little scary when you actually delve into the numbers, and I know we all have. But when we look at Medicare, which has really been in the news quite a bit, especially with the new presidency and the administration talking about cuts and these types of things. There's been a lot of noise about that, but we just want to look at projected costs going out. 2023, the Medicare program costs about $832 billion, and that represented about 3.1% of our GDP, gross domestic product. The projections are calling for, within 10 years, by 2033, the cost of Medicare will be over $16.8 trillion. Mm-hmm. I mean, most people, when you start saying billions or trillions, just can't comprehend what that means.
I mean, large.
By the way,
it's a lot of money.
For our audience, there are, I think, 12 zeros in a trillion. 12 zeros. A number followed by 12 zeros.
It's a lot. It's a lot. And then we go into the Social Security program, which also has been in the news. It's a topic of discussion when we meet with our clients. I would say, for someone that's above 55, approaching towards 60, getting towards the Social Security age, we discuss it in every meeting we have, every financial planning meeting we have with our clients. That is a big topic of discussion. And some are just like, oh my God, I can't plan my retirement for that because I don't think it's going to be there, and all these different things. But when you really look at it, and it's been, a couple years where effectively the cost of the Social Security benefits being paid out has exceeded the income coming in, which means we're dipping into the reserves.
Yeah, the trust fund.
The trust fund. And once again, going out to 2033, the projections call that Social Security, as we know it, with no changes, nothing happens, we just keep going the same, will be insolvent. Now, people hear insolvent and they think zero, nothing left. That's not actually accurate. And this is something that we talk to clients all about. What that means is that your qualified benefit will be reduced, and the projections are that you'll receive about 77% of that qualified
there's not enough FICA taxes coming in to support the benefits that are committed to the people that have taken
right. Because
benefits.
There's two taken out for every one putting in.
There's less than 3 people working for every person that's collecting a benefit, and so currently the trust fund is paying the gap. We're not going to have a trust fund in 10 years to pay for the gap. Right.
And then the big boy in the room, the big elephant in the room is the federal deficit. And I see some people on their computer just have their screen up, just showing the federal deficit, and it just keeps going up and up and up, like minute by minute.
The debt clock.
The debt clock, which is interesting. That's right. And when we look at that, we're at, as a country, we're about $38 trillion currently is the federal deficit. And for just this year that we're in, 2025, the projections are almost 2 million, 1.9 trillion will be added onto the deficit. And then what have we been talking about? The big, beautiful bill, right? Well, most projections and most analysts say that's going to add another $3 to $5 trillion to the deficit with, all the different.
Now we're starting to understand the math that David Walker understood.
Right. And you got to go back and look at when we're talking about tax brackets, talking about tax rates. There's two ways to cure a federal deficit. We reduce spending or increase income.
Or some combination of both.
Yeah, or a combination of both.
Right.
Increase income means taxes. If you're the government, increasing those taxes. So then a little more stat analysis here. Right now, we spend $1.02 for every dollar that we bring in income.
Like 102% of every dollar.
Yep.
Yeah.
And that money is spent on, let's call four major things. One of them is Medicare. The other one is Social Security. Then we throw in Medicaid. Last but not least, interest on the national debt. Everything else the government spends, we borrow. So what does that do? That just increases the deficit. And guess what? If you look at those factors, all the costs for healthcare, all those things are increasing, right? We have the largest demographic baby boomers that are, basically qualifying and taking Social Security. All those numbers are going up. Well, then, even more so, interest on the federal deficit. 10 years, 3-4 years ago, we were in an extended decade of extremely low interest rates. Well, what's happened in the last couple years?
Until recently
interest rates have doubled. Now we're seeing a little bit back, but what pressure does that put on just covering the interest expense? And once again, we've heard a lot about that.
Yeah.
But, you can only kick the can down the road so far.
That's
so
right,
a lot of
man.
what we've been talking about is, gosh, it's great that this favorable tax environment has been extended.
But let's see the big
Permanently,
picture. The
but-
bigger picture.
yeah, the big
So what
picture.
has to happen? I mean, you and I, all three of us, we ask our clients, are taxes going up or down?
Yeah.
Yeah, I have
At some
not. I
point.
haven't spoke to anyone, or even when I asked that question to the client, I haven't had anyone that said, "Oh, taxes are going to go down."
Yeah, when
Like
I teach
every single
when I teach my
person.
classes, I always ask them in every class, "Where are taxes? Does anybody think taxes are going down?" You never see a hand raised.
Yeah.
So they have to. I was surprised that this bill arranged our brackets in a way that for whatever permanent means that it did extend it. So, Ryan,
Yeah.
what do you feel? Are they going up or down?
Well, in a rising tax environment, it's simple. If you just cut through the minutia and you look at all the various places people could put their money, their savings and investment dollars, it can really just be boiled down to there's 3 different types of buckets anybody can put their money into. They can put into a taxable bucket, a tax-deferred bucket, or a tax-free bucket. Now, there's certain planning percentages that we feel are appropriate to keep in each one of those buckets. And if that's something you want to know, come in and see us with that. But the point about that is that the taxable bucket is the least tax efficient bucket to carry a lot of dollars. So we don't want too much in that bucket. Some people have pensions, some people don't have pensions. So the amount to keep in that tax deferred bucket is an individual look. But if in a rising tax environment you have all of your money in a tax-deferred bucket, you're in a pretty big business partnership with Uncle Sam, and every year that goes by, they get to vote on how much more of your hard-earned money they get to keep.
Yeah,
so that's not
your ownership percentage is going down.
That's not a great bucket. It's not a great business
You're losing
partnership.
equity.
Yeah.
So therefore, kind of by definition, is we need to figure out every way possible to reposition money to that tax-free bucket and understand that there's a price of admission to get into that bucket. You got to be willing to pay the tax before you're required to do that. But by doing so and strategizing, it could put you way ahead. Because if David Walker is correct and taxes do double in the future, and you've got everything or as much as you possibly can in scenarios where you could be at or near a 0% tax bracket. If taxes double, 2 times 0 is still 0.
Yep.
And so that's what we mean by an unprecedented sale of a lifetime when it comes to taxes. And not everybody's situation obviously is the same, but if you're not addressing this, or you're not working with people that are having this kind of a conversation with you, you're missing the boat.
Yeah.
All right? There's more to it than just allocating your money towards stocks and bonds and getting 5% versus 6%. There's way more.
And what are some of those strategies, Ryan, that you would want your dollars to end up in, especially if you're looking for growth?
Yeah, so in a rising tax environment, if you're going to try to figure out how to get into that tax-free bucket, there's about 6 or 7. Roth IRAs, Roth 401ks, Roth conversions is a huge opportunity for many people. Certain types of cash value life insurance retirement plans that we've talked about before, if they're structured properly, are fantastic. They're just treated a little bit different underneath the IRS tax code than anything else, which is potentially really awesome. Required minimum distributions equal to or below your standard deduction. So it's okay to have some money in a tax-deferred vehicle, but just equal to or below your standard.
You never pay tax on that,
Right, because it's offset by that standard deduction.
Right.
And people need to know, is their Social Security going to be taxed or not taxed? And how does the government determine if that Social Security is going to be taxed? Because if your Social Security is taxed, you're going to run out of money sooner.
And at what percentage?
If it's going to be taxed at 50%, 85%, 5%. So, and then the caveat, the little bonus, number 7, is an HSA account, a health savings account.
Triple tax bonus.
Triple tax benefit, man. So some of those or all of those, we want our clients to have multiple different tax-free streams of income to like what Ed's talking about, so we can get off the tracks right before the train comes. Kind of like Wile E. Coyote. You remember that episode when he was the Roadrunner pushed him onto the track and he was inside of a shed that was made by Acme and he was building a bomb made by Acme. And he looked out the back and the train was coming, and you guys remember what he did? He pulled down the shade. Thinking that act alone would...
if I can't see it, it's not going to happen.
Not going to happen.
Right, and so the train crashed him, and he's burned. He never dies and everything.
Right.
But we got to get off the tracks. We can't be pulling the shade down like Wile E. Coyote did.
Yeah,
right?
And I really think, in talking to our clients and the listeners out there, financial planning isn't about just picking the right stock or chasing rates of return and everything else. It is really, holistic planning is really involved. And if you're not getting tax planning, because every move you make has an impact on future taxes, your availability and access to those assets in the future. So that type of planning is really, and you guys would all agree, when we sit down and have discussions with our current clients and prospective clients, tax planning is really part of it. No, we're not CPAs, but we're smart enough.
We can help mitigate those taxes.
Right, we help mitigate those future taxes.
When I talk to my classes, I always ask, what's the number one expense you're going to have in retirement? People are like, it's medical. It's not. It's taxes.
Yep.
When you think about it, just think about the percentage of what you pay in taxes. It's by far the number one expense that you're going to have.
Yep.
It's Orion, to your point, I mean, you talked about those strategies that we want to get into, but what makes it even more difficult is, yes, how do you do that? How do you get into those? What is the cost, as you would say, to get into those? But then you got to look at things like, well, what does that mean for IRMA? Could it impact the cost of your Medicare Part B premiums? What does it mean for RMDs, required minimum distributions? What does it mean with the different brackets and being at the top of those brackets? Does it impact the 3.8% net investment surplus cost? Those are just a few of many things that you have to consider when you're looking at doing tax management and looking at those strategies. And so if you're listening, if you're watching, it's complicated and it's overwhelming, and we're here to help with that. So please reach out to us. We enjoy talking about these things, and to your point, Ed, it's not just about rate of return and which funds are you picking. That's part of it, but then there's also the planning component, and the tax management is a big part of that.
Yeah.
So with that,
get off the tracks, huddlers.
Get off the track. One big beautiful bill. It is permanent, and with that, we're so glad that you turned in. Everybody have a great day, and we will talk to you next
everybody.
time.
We'll see you next time.
Take care.